Hello everyone, Luke Gromen, FFTT. Hope everybody's well. I apologize for getting on a few minutes later than I had promised. I hope everybody enjoyed a great weekend and was just wrapping up watching the end of that excellent Euro 2020 final. England came out on the short end, so sorry for my English friends, but excited for my Italian friends. So I'm gonna be pretty diplomatic about the game. So with that, we are going to jump right in to the questions. Thank you everyone for joining us as usual. The first question is from JE. Is the net effect of Michael Saylor's multiple moves within MicroStrategy around Bitcoin accretive or dilutive to existing stockholders? And is there a synthetic strike price or point in time that it becomes one or the other to the new bondholders or existing shareholders? It depends, of course, on what price of Bitcoin, what Bitcoin does. I've not done the math myself. I've read very good analysis of what is essentially a very convex payoff graph in both directions. If Bitcoin rises or if Bitcoin falls. It was put together by Michael Cow, who goes by @UrbanCowboy on Twitter. Definitely a very good follow. If you don't follow him already, Michael Cow, K-A-O, spelling of his last name. At any rate, I believe when he did that analysis that you'd be able to Google and find online, that the break-even point, if you will, of that convex on the upside and downside analysis, the break-even for Bitcoin at that point a couple months ago was about $25,000. So I will answer that and just point you to that because I'm not going to be able to recreate what the excellent analysis he did. From Peter, would love to see you mention something about your last video, debt to GDP at 130% now versus 100% in 2008. Interest rates considerably lower, debt servicing costs also lower. Why does this leave the U.S. in a considerably worse position and not a better one? And I think it's in a worse position because the future optionality is reduced versus what it was then, not just by the higher debt levels and the lower rates, but also by the fact that U.S. entitlement programs have gone significantly free cash flow negative now. And so in plain English, the only politically and economically palatable and possible option left is to inflate the debt away, basically let inflation run hot, while the Fed keeps interest rates below and ideally well below the rate of inflation, in other words, significantly negative real interest rates, and then tries to convince the public that inflation is transitory, inflation is more tame than it is. And interestingly, this, to my eyes, appears to be exactly what U.S. policymakers and global policymakers more broadly are doing. It's the only playbook they have. I can't fault them. They let the system evolve to this point. Once the COVID crisis hit, they have only one option, really. Multiple questions regarding the Basel III NSFR, net stable funding ratio for gold rule change carve-out for the LBMA. I did see that. I have been reading about it a bit. I have not concluded on everything yet. I'm still digging into it and trying to fully understand it. With that said, a couple things that grab my attention about it. Number one, apparently is specifically for clearing, not for loans and leases in the gold business. And it appears that the EU and US are still abiding by those rules, while as the LBMA in London has a carve-out. What does that mean? I don't fully know yet. My gut tells me with an incomplete understanding that if the LBMA is celebrating and high-fiving this carve-out, it's probably not a positive for the thesis, for my thesis, that this NSFR appears to be an unwind, a mandated unwind of the unallocated gold market in London. With that said, let's see exactly what it means, because again, it's for clearing, it's not for loans and leases. So more on it as I get a chance to really dig into it and kind of feel it out, but those are my initial thoughts. From WD, riff on China, credit tightening, new ambassador, tech crackdown, capital controls, etc. The Chinese credit tightening, to me, that has been happening. There's China credit impulse is cited by a number of different brokers. There's a data series on it on Bloomberg, I believe. At any rate, it has rolled over sharply in the last, call it 3-4 months. I think you've started to see those deflationary impulses in a number of different asset markets, commodities, U.S. Treasuries, etc. With that said, I think something that happened last week that didn't get enough airplay was China coming out and saying that they are looking at cutting their required reserve ratio, or triple R, to try to stimulate their economy more, to stimulate small business growth in their economy more. This was a surprise. It was not expected, and to the extent that it is followed through on may mark a reversal in the China credit tightening worth watching. In terms of the tech crackdown, I'm probably not the right guy to talk to on it. I mean, ultimately, I think two things I've read that have caught my attention. Number one, the tech crackdown appears to be a difference of philosophical views. The Chinese state wants the state to have the greatest power over the collection of tech data, the usage of tech data. The U.S. is ostensibly or nominally okay with private companies collecting and using that data. As a practical matter, if we really call things what they are, I would argue that the U.S. tech companies with the most data, names like Google or Facebook or Amazon, Alphabet, are de facto relatively, they have very close relationships with the U.S. state, I would argue. And so to me, it comes down to which government do you feel better having your private data, and that is ultimately USA hands down. And so I think over time, that is positive for capital flows. With that said, that's an all else equal equation. In the last year, we've actually seen capital, on a net basis, move to China from the U.S. on the interest rate differential. You get 300 basis points more in Chinese government bonds than you do in the U.S., and people are saying, investors on the margin are seeing that as an adequate compensation for the other risks involved with investing in China as opposed to the U.S. So watching the tech interest with great interest. I think ultimately U.S. tech in much better position because of that one key factor, which is ultimately, I think most people in the world would feel much better with the U.S. government handling their data than the Chinese government. Or U.S. government proxies than the Chinese government is probably the better way to put it. From H, how much longer do you think the U.S. has before a debt default or solution to reserve currency status? Also, do you think politically that Democrats will try to keep the economy propped up, low rates, print as much as possible before the 2024 election? Two-part question there. I don't think the U.S. will ever explicitly default, as I noted, the only politically and economically palatable option left really at this point post-COVID is to try to inflate the debt away, keep interest rates well below the rate of inflation, try to convince the public that inflation is both well below what it actually is, and that whatever modicum of inflation exists is transitory and will go away soon. And so I would say that process of financial repression, slow default, whatever you want to call that, I think it's already underway on some level. I don't think it's moving fast enough, but I think it's underway on some level. In terms of the reserve currency question, to me there are two constituencies within Washington, D.C. with two diametrically opposite views of the dollar and the dollar system as it's been structured since 1971. I think there is a large group that still sees the post-1971 dollar system as structured since Nixon closed the gold window as a major U.S. advantage. And I think there's a second group that realizes that it has actually become a disadvantage for the U.S. that China is repeatedly using against us. Pre-COVID, the first group, the former group, the group that saw the dollar system as structured post-71 as nothing but an advantage, that group dominated policy discussions, etc. Post-COVID, when even tourists to the dollar system, the currency systems, to global supply chains could get on the news and see, hey, we can't get drugs, we can't get PPE, we can't get masks, we are completely vulnerable and open to China and China's whims, something needs to change. I think the group seeing the dollar system as structured post-71 gained a lot of members post-COVID because of that. And so I think It's a much more evenly matched discussion between the group that sees in Washington that sees the dollar system as purely an advantage, and the group that sees it realizes that it is increasingly a disadvantage. I don't know how those two sides will end up netting out. I think it is still open for debate. I think it's still an open contest with both sides trying to push their agendas, if you will. In the meantime, it appears to us, the preponderance of the evidence suggests that the world continues to move toward what appears to be the new system, which is a multi-currency pricing of commodities and settlement, effectively settlement in countries' exported goods with any net amount left over settling in physical gold. And so if you've got basically the U.S. has historically settled trade in financial assets, and the world increasingly wants either finite financial assets. In other words, the Chinese will happily sell us goods, but in return for that, they will no longer take treasuries. They will take increasingly large ownership stakes in U.S. companies. And so the question then becomes is it in the United States' interest for us to sell Amazon, Google, Facebook, Lockheed Martin, etc.? And those are not necessarily specific exact examples, but I want to try to make the point here. So this is a bit over the top to make the point, but the point is that we send dollars to China, China sends goods, China then takes the dollars. They used to buy treasuries and just buy more and more and more treasuries. That worked out great. They're not buying the treasuries now. Now they're buying finite stakes in U.S. companies, U.S. assets, global ports, etc., strategic assets. And that's why I say the dollar system is structured is sort of already breaking down. They're not buying treasuries anymore. We're basically hawking our crown jewels to China for ongoing supplies of stuff we buy in stores, pharmaceuticals, masks, etc. My view has long been that is not in the interest of the United States to continue doing that ad infinitum. And as I noted before, there is a growing group of people in Washington that realize that also that is not in our interest as a nation. There's still a large group in Washington that think that for some reason is in our interest, and I won't go into it more than that. I guess the last part of that question is do I think politically the Democrats will try to keep the economy propped up? I think both sides are going to try to keep it propped up. I think we may see some kabuki theater around Republicans like Joe Manchin trying to hold things up for his constituency within West Virginia, or other Republicans within their respective constituencies. However, again, it goes back to where the fiscal situation is post-COVID. It really doesn't matter, I think, which side is in power. There's only really one politically and economically palatable possible playbook, which is you've got to grow GDP well in excess of inflation, keep interest rates well below the rate of nominal GDP, and try to grow your way out of it over time. And so I think that will continue to be the playbook from Democrats, Republicans, Independents, everybody. And so I think it's going to be real important to, if there is an actual holdout and things do get held up, that is a very big problem. It's a very risk off in my view, and it would likely be good for the dollar. It'd be good in the short term for treasury bonds, and it'd be bad for virtually all of their asset classes. I don't think such a risk off period will last very long, because I think ultimately, I don't think Congress would have to come into their office for too many days with the Dow down 500 to 1,000 points, too many days in a row. Before the market would basically browbeat Congress into doing what had to be done to kind of keep things going. Because again, post-COVID, we're left with this unsustainable fiscal position in the U.S. specifically, but particularly in Western social democracies, but around the world as well. So with that, I am going to sign off for tonight. I want to thank everybody once again for joining me. It's great, as always, catching up. And as always, if you're interested in what we're up to or like these updates, check us out at FFTT-LLC.com. for more information about upcoming appearances, as well as our tree rings product. And as always, everybody, thank you very much. Have a great rest of your weekend. We'll talk to you soon. Take care, everyone.